These 9 legal tax tricks are the reason billionaires pay less tax than you. First, step up in basis. Here's how it works. Instead of paying the capital gains on an inherited asset when the owner dies, the value of the asset is stepped up from the initial purchase price. This means that the gain in value from appreciation is lower, so there is now less or no capital gains tax to pay on that asset. Say your billionaire daddy dies and leaves you $1 billion estate for you to strut around in, and it is worth $50 million. But he bought it 20 years ago for $20 million. Normally, there would be tax on the gain, which in this case is $30 million. But if there is a step up in basis to $50 million, then all of a sudden, there is no capital gains. Pretty neat. This is why wealthy families pass down wealth for generations with almost no tax. 2. Borrowing against assets. You ever wondered how billionaires like Elon Musk and Jeff Bezos don't pay any tax? This is why. They do not actually get paid a substantial salary. They just own the stock in the company. This means that they can go to the bank and borrow money, and when the bank asks for collateral on that loan, they just use their stock. The reason this works is that they are able to borrow with insanely low interest rates because of their reputation. And debt isn't taxable income. So, just like that, they can borrow $1 million and not pay a penny in tax on it. And because of their low interest rates, they only need a small salary to pay back the interest on the loans, so they can just keep taking loans out until they die. It's the buy, borrow, die strategy, and it works. Third, depreciation. Real estate. Real estate has a long list of cheat codes, the first being depreciation. The government can say that your real estate has made a loss in depreciation, even if the price has gone up. This fake loss is a real tax deduction. Therefore, the tax deduction can be written off against your gain, and you don't have to pay any tax on it. Secondly, you can take huge write-offs from segregating smaller parts of a property. If you think wiring and pipes will depreciate faster than the rest of the building, that depreciation can be used as a write-off now, not decades later, helping you pay less tax. Fourth, like-kind exchange. Are you selling a building? As long as you buy another building soon to cover that income, then you do not need to pay any tax on it. That profit is just used to buy another house and then another and so on. You can just keep trading up tax-free. 5. Carried interest. Financial institutions often offer large salaries to its high performers, but that means lots of tax. Fortunately, carried interest means that the fund managers can be issued funds that are not subject to any income tax at all. This is because it is performance-based, issued by fund managers. They only have to pay capital gains tax, which in nearly every country is significantly less. They don't get taxed like workers. They get taxed like investors. 6. Charitable trusts and foundations. When someone dies, they tend to like leaving money and assets for someone, but this is taxed and the wealthy hate taxes. Charities can actually be used to avoid paying taxes and pass wealth down without too much of a loss. This is because the donations to the charity reduce the taxable amount for whoever inherits the estate, and it also means that the owner's assets, such as stocks, bonds, properties, and more, can be transferred into the trust, so the heir can inherit them. Trusts also enable the owner to pay out to the heir on certain conditions, like if they want their son to graduate from school before receiving the money. Pretty smart, and saves a lot of money for generations. 7. S-Corp income splitting. Employing an S-Corp structure can lower the self-employment tax by reducing the taxable income. It works by splitting the taxable business income into 2 key components instead of just paying tax on all of it. This is salary and distribution. This is because only the salary portion of the income is actually taxable. Only the salary is hit with employment tax. The rest, called distributions, skips that entirely. This type of business benefits from limited liability and relief from double taxation. This means that if they are sued or in financial difficulty, they do not need to cover expenses with their own money. 8. Backdoor Roth IRA. A backdoor Roth IRA means that high earners are able to contribute to their Roth IRA even when their incomes don't allow them to. This is because they make a post-tax non-deductible contribution to the regular IRA and then immediately change their IRA into a Roth IRA. And then when filing taxes, the IRS will think that the contribution is taxable, so they fill out an 8606 form to tell them that it is not taxable. Then they can retire with much more than they would have prior. 9. Offshore corporations and tax havens. You're not hiding earnings, just choosing to incorporate in a low-tax country. Perfectly legal and perfectly profitable. Why pay 30% tax when another country only asks for 12%? This is of benefit because different countries have different tax liabilities, which attracts external investment. This enables companies to pay less corporate tax and therefore make more profit. You ever wondered why Apple operates in the Republic of Ireland? Yep, that's because there is less corporate tax there than there is in California.